You feel that, don't you? That cold knot in the pit of your stomach as you watch the numbers on the screen. The stock you bought with such conviction, the one that was supposed to be your ticket, is bleeding. It's glowing red. 10% down. Your mind starts racing, searching for an anchor in a storm of panic. It's just a pullback, you tell yourself. A healthy correction. The fundamentals are strong. You are lying to yourself. The price is telling you the truth, but you refuse to listen. You are arguing with the tape, and you are about to pay the highest tuition in the world for that lesson. This is the moment a speculator dies and an involuntary investor is born. It is the most dangerous transformation in Wall Street. You entered the trade with a plan, a stop-loss, a clear idea of your risk. But the moment the price went against you, your plan evaporated. It was replaced by a single cancerous emotion, hope. You hope it will come back. You hope you can get out at break-even. Hope is the siren song that has led more men to financial ruin on Wall Street than all the bear raids and panics combined. You see, a man is biologically engineered to hope. It is what keeps him going through hardship. But on the trading floor, hope is poison. It is the enemy of discipline, the antithesis of a sound mind. When you hold a losing stock, you are no longer speculating on its potential rise. You are betting against the proven reality of its fall. You have abandoned the realm of mathematics and probability and entered the world of faith and prayer. And I can tell you from a lifetime of experience, the ticker tape is deaf to your prayers. I learned this lesson the hard way, as all men must. It was early in my career. I had made a nice little fortune, and I felt invincible. I was trading cotton, and I had a very definite theory about the market. I backed my opinion with my money. The market should have gone my way. All the reasons were on my side. But it didn't. It began to go against me. The price sagged, then it fell. I was getting margin calls. My broker, a wise old man named A.R. Fullerton, took me aside. He didn't tell me what to do. He just looked at me and said, "Jesse, if you can't sleep at night because of your stock market position, then you have gone too far. If you are in that position, then sell down to the sleeping point." But I was young. I was arrogant. I thought I was smarter than the market. I believed my analysis had to be right, and the price action was just a temporary insanity. I held on. I told myself, it will come back. I remember sitting there watching the quotes, my capital shrinking with every tick down. The initial small loss, the one I should have taken without a second thought, had metastasized into a monster. It was no longer a simple trade. It had become a personal battle between me and the market. My ego was on the line. I couldn't admit I was wrong. To sell now would be to accept defeat. The final margin call came. I was wiped out. Everything. Gone. In the silence that followed after the shouting in my head had stopped, the clarity was blinding. My catastrophic loss was not the market's fault. It wasn't bad luck. It wasn't manipulation by some unseen force. The fault was entirely my own. I had failed to obey the most fundamental rule of the game: cut your losses quickly. My mistake was not in making a bad trade. Every speculator makes bad trades. My mistake was in staying with it. I had let a trade become an investment against my will. I had become the classic sucker, the man who averages down, who keeps throwing good money after bad, convinced that he can force the market to vindicate his opinion. The market never vindicates an opinion. It only validates a position, and only when that position is on the right side. That day, I learned that being wrong is forgivable. Staying wrong is professional suicide. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below. This brings us to the great law of self-preservation in the stock market. A speculator must have an insurance policy. Your only insurance against catastrophe is the immediate and ruthless acceptance of a small loss. When you buy a stock at 100 and it goes to 95, you must have the courage to admit that your initial judgment might be flawed. The market is sending you a signal, a warning. To ignore it is to put your head in the sand. The amateur sees a 5-point loss and thinks, it's only 5 points. It can come back just as easily. He sees the loss as an abstract number. The professional sees a 5-point loss and thinks, this is a 5% erosion of my capital. If I allow this to become a 50% loss, I will need a 100% gain just to get back to even. The professional thinks in terms of capital preservation. The amateur thinks in terms of getting even. Getting even is the most expensive goal a man can have in Wall Street. Let us apply this timeless law to the market you see today. A new technology company captures the public's imagination. Its stock soars. Everyone is talking about it. Your neighbor, your barber, your brother-in-law. They are all geniuses. They bought at 50, it's now 150. You feel the pull of greed, the fear of missing out. You jump in. You buy at 150. For a week you feel like a king. It goes to 160. You're already calculating your future profits. Then the tide turns. A bad earnings report, a shift in sentiment. The stock drops to 140. What do? The involuntary investor inside you whispers, this is a buying opportunity. The story hasn't changed. I'll buy more and lower my average cost. This is the cardinal sin, averaging down. It is the financial equivalent of a doctor giving more poison to a sick patient. You are reinforcing failure. You are doubling down on a mistake. A professional operator, if he finds himself in a losing position, does the opposite. If he buys a stock and it goes against him, he sells. If he is truly a master of the game, he might even go short and reverse his position, aligning himself with the new line of least resistance. He does not argue with the facts. Price is the only fact that matters. The stock drops to 120. Now the involuntary investor is in serious trouble. He can no longer call it a dip. Panic sets in, but his ego won't let him sell and take a 30-point loss. It's too painful. So he performs a mental trick. He reclassifies the trade. I'm not a trader anymore, he declares to himself. I am a long-term investor. This company is the future. I'll hold it for 5 years. He has just shackled himself to a corpse. His capital, the lifeblood of his business, is now frozen in a losing enterprise. While his money is trapped, new leaders emerge in the market. A different sector, a different stock begins a powerful bull run. But can he participate? No. His funds are tied up. More than that, his mind is tied up. He spends his days watching his losing stock, praying for a rally, scouring the news for any sliver of good news that might justify his decision. He is emotionally crippled. A losing position clouds your judgment. It makes you timid when you should be bold and reckless when you should be cautious. The only way to regain clarity is to sell. Take the loss. Wipe the slate clean. Only then can you look at the market with fresh eyes and an open mind, ready for the next real opportunity. Remember this: a loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. You must learn to differentiate between a trade and a hope. A trade is based on a thesis, and it has a predetermined point of invalidation. Your stop loss. A hope is an emotional attachment to a position that has already proven you wrong. The public has a terrible habit of holding on to their losers while taking profits on their winners. It is completely backward. If you have a portfolio of 10 stocks and 7 are doing nothing, 2 are losing money and 1 is showing you a handsome profit, which one will the average man sell? He sells the winner. He wants to lock in the profit. He is afraid the profit will vanish. So he cuts his flowers and waters his weeds. He sells the one stock that is proving him right and keeps the 9 that are proving him wrong. This is the path to mediocrity at best, and financial ruin at worst. The correct method is to do the precise opposite. You must have the courage to hold your winners, the stocks that are acting right, that are moving along the line of least resistance. And you must have the discipline to sell your losers, the ones that are not performing as expected. Your job is not to be a nurse to sick stocks. Your job is to be a speculator, and a speculator rides the trend. You cannot ride a trend that is going against you. Think of your trading capital as your army. Every dollar is a soldier. When you send your soldiers into battle, when you buy a stock, you expect them to conquer new territory and bring back prisoners, which are profits. If you send a platoon into a position and they immediately get pinned down and start taking casualties, a loss, you do not send in reinforcements, you do not average down. A wise general orders a retreat. He pulls his soldiers back to save them for a battle they can win. To leave them there to be slowly wiped out is not bravery. It is madness. The stock market is never wrong. Your opinion often is. The moment the market's action disagrees with your opinion is worthless. The price of a stock is the final verdict of the collective mind of all market participants. It is the sum of all hopes, all fears, all knowledge, and all ignorance. To bet against the price is to bet against that collective verdict. It is an act of supreme arrogance. The phrase, "it will come back," is perhaps the most expensive 4-word sentence in the English language for a speculator. It is the lullaby of the lazy mind. It absolves you of the responsibility of making a hard decision. It replaces action with inaction, discipline with blind faith. When a stock starts to fall, nobody knows how far it will go. A stock that is at 80 today could be at 70 next week, 50 next month, and 10 before the year is out. There is no law that says a stock must stop falling. Wishing for it to return to your purchase price is not a strategy. It is a fantasy. Your first duty is to protect yourself. You cannot make big money if you lose your trading stake. Therefore, the first step in any speculative campaign is to determine your risk. Before you even place the buy order, you must know at what price you will get out if you are wrong. It should not be an emotional decision made in the heat of battle. It must be a cold, calculated business decision made beforehand. If the stock hits that price, you sell. You do not hesitate. You do not reconsider. You do not hope. You act. The debit slip you get from your broker after selling for a loss is your receipt for your education. It is proof that you are treating this as a business. The man who refuses to take a small loss is destined to take a very large one. He thinks he is being patient, but he is merely being stubborn. He thinks he is an investor, but he is a victim. The market is a cruel master, and it has no pity for those who cannot face reality. The reality is the price on the tape. Nothing else matters. Not the news, not the earnings, not the analyst ratings, and certainly not your hopes. So, look at your portfolio. Look at those positions that are underwater. Be honest with yourself. Are you a speculator who has made a mistake, or have you become an involuntary investor chained to a losing proposition? Are you holding it because your research tells you it is about to turn? Or are you holding it because your ego cannot bear the thought of admitting you were wrong? The pain of taking that loss is sharp, but it is temporary. It is the pain of surgery that removes a cancer. The prolonged agony of holding on, of watching your capital wither away day after day, that is a chronic disease that infects your mind and ruins your ability to think clearly. There is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. It is because human nature is unchanging. People will always be susceptible to the same emotions: greed, fear, and, most destructively, Hope. The speculator who wishes to succeed must fight these enemies within himself. He must learn to think and act differently from the crowd. When the crowd is hoping, he must be analyzing. When the crowd is panicking, he must be assessing. And when he is proven wrong, he must exit with the cold efficiency of a machine. Do not become an involuntary investor. It is a title nobody wants and a position that leads only to despair. Be a professional speculator. Acknowledge your mistakes, take your small losses, and live to fight another day. Your capital is your ammunition. Do not waste it on lost causes. Protect it at all costs, for it is the only tool you have to build a fortune in this great game.